On the morning of November 2, 2022, FTX was worth $32 billion. Within the span of minutes, everything fell apart. FTX's trading firm, Alameda Research, had just suffered from a news leak. An article by CoinDesk revealed that Alameda Research held $5.1 billion worth of FTT tokens, which was FTX's flagship cryptocurrency. While subtle at the time, this was the iceberg that would sink the Titanic. On November 6, FTX began to sink. The CEO of Finance, CZ, had announced that he would be liquidating $2.1 billion of FTT tokens. This was a declaration of war. CZ had just discovered that Alameda Research was not just a company tied to FTX, but practically was FTX. If he could make Alameda Research sink, FTX would as well. As the FTT token began tanking, so did the value of Alameda Research's assets. Hundreds of millions of dollars were almost instantly withdrawn from FTX. The bank run had officially begun. By the end of November 6, over $5 billion of assets were withdrawn from FTX. FTX only had a little over $6 billion on hand, so that only left $1 billion in cash left for customers to withdraw. The CEO of Alameda Research, Caroline Ellison, was terrified. She tweeted, "CZ, if you're looking to minimize the market impact on your FTT sales, Alameda will happily buy it all from you today at $22. CZ knew this was a sign of weakness. He knew that if he kept selling the FTT token, Alameda Research and FTX would go down. So rather than taking on Alameda's offer, CZ stated, "I think we will stay in the free market." The CEO of FTX, Sam Bankman-Fried, also known as SBF, was in shock. CZ was about to destroy SBF's entire career within days. As the withdrawals continued, SBF frantically tweeted, "A competitor is trying to go after us with false rumors. FTX is fine, assets are fine, these were all lies." But SBF was desperate. He needed to stop the withdrawals now or the credibility of FTX would be tainted forever. SBF further soothed the crowd by saying, "FTX has enough to cover all client holdings. We don't invest client assets, even in treasuries." FTX, a crypto exchange, made false claims about their ability to cover client holdings and process withdrawals. In reality, they did not have enough to cover all client holdings and they did invest client assets, and they were not going to continue processing all withdrawals. By Tuesday, November 8, $6 billion was withdrawn from FTX. Users were trying to withdraw even more money, but FTX simply didn't have the cash on hand and the numbers on their screen were all a facade. SBF, the founder of FTX, was forced to give in to CZ's demands, and in a shocking turn of events, he called CZ with an offer to sell FTX to Binance. CZ saw this as a modern opportunity to become the Rockefeller of crypto. FTX was the number 2 exchange by volume and Binance was the number 1 exchange. If CZ were to buy FTX, he would not just become a crypto giant, he would become the crypto monopoly. But after taking a closer look at FTX's financials, CZ was appalled by several red flags. SBF, the founder of FTX, was committing fraud. In order to understand why CZ was so horrified by FTX's financials, we have to rewind all the way back to how SBF started FTX. Shortly after graduating from MIT, SBF began his career as a quant trader at Jane Street Capital trading ETFs. This experience that SBF obtained at Jane Street set the stage for the founding of Alameda Research. Jane Street is one of the most prestigious trading firms focused on market making for ETFs. Market makers aim to buy and sell identical assets near the market price. As a trader at Jane Street, SBF recognized the potential that market makers have to generate substantial amounts of money by buying ETFs from a seller at $100 and selling it to a buyer at $100.50. This would provide liquidity to buyers and sellers, and allow them to buy and sell ETFs almost instantly. SBF, while still trading at Jane Street, recognized an opportunity in the blooming crypto market, specifically in 2017 when the price of Bitcoin reached almost $20,000. He saw an opportunity to apply the same strategies he learned at Jane Street to crypto, and fueled by his insane appetite for risk, this is the reason why he wanted to enter the crypto industry. SBF, in order to fuel his desire to make riskier decisions and amass larger sums of wealth, as stated on Sequoia Capital's website, started Alameda Research, a new quant fund that engages in arbitrage trading, which is buying identical assets at a lower price in one market and selling them at a higher price in another market. He saw that in Korea and Tokyo, there was a significant price premium for Bitcoin relative to the US. Alameda Research, a quant fund founded by SBF, made significant profits by buying Bitcoin at a lower price in the US and selling it at a higher price in Korea and Tokyo, where the price of Bitcoin was 30% and 10% higher respectively. Within months they made $20 million, but as other traders caught on to the scheme, the opportunity dried out by early 2018. After the opportunity to trade Bitcoin dried out, SBF expanded into new opportunities by registering FTX as an Antigua and Barbuda company in April 2019. As a tax haven, Antigua and Barbuda offers practically zero taxes for international business corporations, and as a result, SBF incorporated numerous FTX subsidiaries, including FTX Digital Markets Limited in the Bahamas, which would be used as FTX's headquarters. The start of SBF's biggest venture ever, FTX, marked the beginning of a new opportunity for him. Within the first 6 months of starting FTX, SBF was contacted by CZ from Binance, who saw the potential in FTX and was interested in buying a portion of the exchange. In October 2019, CZ offered to buy 20% of FTX for $100 million. SBF saw this as an opportunity to accelerate the growth of FTX by partnering with the biggest player in the industry. SBF accepted CZ's offer of buying 20% of FTX for $100 million, which turned out to be the worst decision in his life later on. For the first year of FTX's launch, Alameda Research played a crucial role in the crypto exchange's success, accounting for almost half of the trading volume on FTX through market making, which allows to buy and sell the same asset at different prices to speed up the time for trading. SBF realized that the fact that FTX was dependent on Alameda was not sustainable in the long term, due to conflicts of interest between the two companies, such as Alameda having secret access to FTX's proprietary trading data, which could be illegal. Despite this, the two companies continued to operate as if they were one, which was not a good long-term strategy. SBF and his team created a complex corporate structure to avoid various regulations set on cryptocurrencies. Rather than having just two entities, they set up multiple entities that were difficult to follow. For example, Alameda Research had several entities, such as a British Virgin Islands entity named Alameda Research Limited and a US entity in Delaware called Alameda Research LLC. This made it hard to trace the flow of funds and evade regulations. SBF created a convoluted corporate structure that allowed him to engage in illegal activities through Alameda's British Virgin Islands entity while still operating in the US. His laziness was also evident, as he admitted to frequently playing League of Legends while on phone calls. This laziness would reveal itself when in May 2021, FTX was applying for a license in Gibraltar, an overseas territory in the United Kingdom. When FTX was applying for a license in Gibraltar, one of the requirements was a request for information from its major shareholders, one of whom was CZ, who had purchased 20% of FTX just 1.5 years ago. FTX contacted Binance over 20 times between May and July 2021 for various details about CZ, such as his sources of wealth, banking relationships, and ownership of Binance, but there was no response. Frustrated by CZ's lack of response, SBF bought back CZ's stake in FTX for $2 billion, paid through crypto, including a significant portion through FTX's token, the FTT token. This would give CZ an edge over FTX later on. In July 2021, SBF's alleged romantic partner, Caroline Ellison, was appointed as the CEO of Alameda Research. SBF recruited her from Jane Street and believed she would be able to run Alameda without a problem. Appointing Caroline as CEO of Alameda Research was a poor decision due to her consistent use of amphetamines and her public statement that she only used elementary school math. Her lack of skills would reveal itself in less than a year. During this time, SBF wanted to get retail investors to join FTX. To attract retail investors to FTX, one of the ways SBF aimed to do this was to get on the rankings of the top crypto exchanges. As FTX was a relatively new firm, SBF needed to solidify its credibility, so he agreed to have FTX audited by an accounting firm, but not just any accounting firm. He chose to work with Prager-Metis, the first accounting firm in the metaverse. SBF chose to work with Prager-Metis, an accounting firm known for operating in Decentraland, a metaverse where people buy and sell virtual land, and also being the sponsor of the Decentraland Baby Dolls, a group of metaverse dolls that would dance in the Decentraland doll house. This may seem ridiculous, but SBF believed this was a perfect opportunity to easily pass an audit. In August 2021, SBF announced on Twitter that FTX and FTX US passed GAAP audits. The entire crypto world was deceived by SBF's actions. After passing a US GAAP audit, it was believed that the company could not be fraudulent. To further prove his point, SBF testified before lawmakers in December 2021 to improve the oversight of crypto and described how FTX had an unparalleled risk monitoring system that was stronger than the traditional financial infrastructure. SBF's claim that FTX had an unparalleled risk monitoring system that was stronger than the traditional financial infrastructure, along with the fact that he not only passed a GAAP audit but also testified, caused many investors to trust FTX as a risk-free exchange. He stated that it's true of our risk engine, which is a 24/7 risk engine that is unlike the traditional financial ecosystem where risk builds up overnight, where there need to be separate missed risk models for weekends and overnight activity and holidays, where hours or days can go by with no ability to mitigate risk to the system. In May and June of 2022, FTX was hit with major challenges that ultimately revealed the truth about the company. When two major crypto players, Voyager and Celsius, suddenly went bankrupt, leaving Alameda Research, who had significant exposure to both firms, with substantial losses, forcing them to seek capital to avoid bankruptcy. FTX was in a dire situation. With Alameda Research facing significant losses, SBF's only option to save the firm would be to illegally transfer $16 billion in customer assets from FTX to Alameda, going against the promises of one-to-one backing for customer deposits, but he knew that this would be a violation and a betrayal of trust for his customers. In June of 2022, SBF was faced with the decision of saving Alameda and FTX from bankruptcy. He chose to transfer over $10 billion of customer deposits from FTX to Alameda, a move that could have led to the collapse of both companies if customers had known and withdrawn their money. He had a solution to avoid this. He silenced the internal compliance team to make the transfer without raising any alarm. In order to save his companies, SBF used a backdoor to transfer over $10 billion of FTX's customer deposits to Alameda, without alerting the compliance team. Only a few executives were aware of this decision, and when crypto lending platform BlockFi was also in trouble, Alameda had a large exposure to it. SBF was desperate to save Alameda and FTX from collapse, so he used a backdoor to transfer more than $10 billion, over half of FTX's customer deposits, to Alameda, without alerting the compliance team. Instead of facing the losses, he also gave BlockFi a $250 million credit facility and signed the Giving Pledge, a commitment from billionaires to give away most of their wealth to philanthropy, to solidify his credibility and show that he had a high moral standard. SBF was desperate to save Alameda and FTX from bankruptcy, so he used a backdoor to transfer funds without alerting the compliance team, and lent Alameda over $10 billion, which was more than half of FTX's customer deposits. He also gave BlockFi a $250 million credit facility and signed the Giving Pledge, solidifying his credibility as a philanthropic businessman. However, his ego got the best of him as he became unhappy with FTX's lower ranking in trading volume compared to Binance and felt that he had a cleaner record. SBF dissed CZ on October 29 by saying excited to see him repping the industry in DC going forward. He is allowed to go to DC, right? CZ was understandably furious at SBF's words and responded by taking down SBF once and for all. As CZ had over $2 billion in FTT tokens, he knew that he had enormous leverage through his FTT tokens. On November 2, a leaked report revealed Alameda Research's balance sheet, which led to CZ, who had over $2 billion in FTT tokens, to begin to dump his tokens, and 4 days later, CZ received an offer to buy FTX from SBF with the contingency that he would be able to back out of the deal at any time. But upon reviewing FTX's financial statements, CZ was dismayed by the hole SBF had dug himself into. SBF had promised to buy back CZ's stake for an astounding $2 billion, but as CZ began looking into FTX's financial statements, he discovered that between $1 billion and $2 billion of Alameda's assets had vanished, and CZ immediately backed out of the deal, as it would take billions to save the disaster that was FTX, and he couldn't trust the data anymore. SBF dissed CZ's legal troubles by saying, excited to see him repping the industry in DC going forward. He is allowed to go to DC, right? CZ was understandably furious at SBF's words, and as a result, CZ leaked a report revealing Alameda Research's balance sheet, began to dump his FTT tokens, and discovered that between $1 billion and $2 billion of Alameda's assets had mysteriously vanished, so he immediately backed out of his deal to buy FTX. Later that day, SBF announced that he would be looking for $9.4 billion in rescue funds, revealing that FTX was not Lehman, but a fraud like Enron in the 2000s, made possible by SBF's deceptive tactics. On November 10, SBF announced that FTX US was totally fine and 100% liquid, claiming that it was a separate company from FTX International and therefore not affected by the latter's questionable activity, despite being based in the Bahamas and having questionable financial accounts, which allowed SBF to get away with it due to lack of proper oversight. SBF's fraudulent activities were able to go unnoticed due to questionable financial accounts in the Bahamas and overseas subsidiaries such as FTX US, which he claimed was separate and unaffected by FTX International's troubles, but ultimately filed for Chapter 11 bankruptcy proceedings along with FTX and Alameda Research. And to make matters worse, a hacker siphoned over $600 million from FTX's crypto wallets on the same day. The story of FTX is one of deception, greed, and ultimately destruction, as it was revealed to be a fraud built on questionable ethics, an insane risk appetite, and an intricate web of lies and illegal activities, all masterminded by the company's CEO SBF, who ultimately filed for bankruptcy after the company lost over $600 million to an unknown hacker, and with the added revelation of FTX US being falsely stated as completely fine, it raises suspicions of an inside job. The regulatory implications of this event will have far-reaching consequences. If you enjoyed this video and want to see more videos like this, please hit the like button and subscribe. Thank you all for watching, and I'll see you in the next one.